Here's what's coming up on today's show.
There was one carrier that said, if someone even turned in a claim and we didn't pay a penny on it, we're not going to offer them coverage because you're a higher risk because you thought to turn in a claim. So it's a rough market.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host on the East Coast, Mr. Tom O'Connell. Tommy, it's been a couple months. How you been?
Yes, Mr. John, Dr. John, how's it going? Everything's good out here on the East Coast. Spring is finally here. Winning baseball, not the Mets, the Yankees.
Yeah, how's that Soto deal working out, huh?
We don't miss Juan Soto. We do miss Garrett Cole, but pretty soon we're going to have a young Jake Imarino in our starting lineup.
Maybe not the Yankees. We're making the trip out. It's coming up here, Tommy, a couple months out to Cooperstown. So hopefully he's dialed in right now. He's hitting the cover off the ball. He just threw a shutout in his last outing, and then his glove is just, it's what he does. So,
and then we have another budding superstar in Haley Bailey.
Yeah, so she just turned 7 this weekend, so I gotta give a shout out to my little princess. 7, and so we had her birthday. We had 4 girls sleep over on Friday night, 4 7-year-olds, and then a lot of singing and dancing going on there. And then we had her birthday on Saturday with friends and family, and then we had Easter. So it was a good weekend. Weather here getting to be San Diego like.
Good.
So, well, folks, a lot's been going on the last couple of years in the property and casualty insurance. And living in California, you probably saw some headlines out here of people not being covered, and with the Palisades fires, and then the floods in North Carolina, and a lot's been going on. So Tom and I thought we'd bring on our good friend who is a CEO of an insurance and investment company in Seattle. And he's a wealth of knowledge. I've gone to him when I've had a ton of property and casualty or asset protection questions for my clients. He's also an investment advisor with Brookstone Capital Management. So I want to take the time and welcome our good friend, the CEO of Vault Insurance and Investments, located in Seattle, Washington area, Mr. Matt Burklund. Matt, welcome to the show.
And today's guest, the CEO of Vault Insurance and Investments, Matt Burklund.
John, Tom, it's great seeing you both today. I'm so proud to be on your nationwide broadcast here. So thank you for inviting me. It's an honor. But high level, there's a lot going on in the market. Why don't we start nationwide? Nationwide, ever since 2019. 2019, we started seeing some supply chain issues, inflation. Back in the day, a bumper for a car used to be $200-300. Now they're $2,000-3,000, if even that, if not more, just because of all the cameras and sensors. And then anytime the economy starts to get slow, you think of 2022, we definitely had a down market and people get a little tight financially. What that means is they're turning in every little nickel and dime claim, whereas before they'd pay cash, now they're turning it in. And all that money has to come from someone's pocket. So high level, started with inflation, supply chain issues. I had a good friend of mine replace a window on their car, and this is in 2020, it was $2,000. 10 years ago, that window would have been $200. So expenses are higher. On top of that, we have, in the last 5 years, insurance companies have paid out there's been over $115 billion in claims. And that's 115 separate $1 billion claims. The total claims were over $745 billion. So eventually, companies run out of money, and the only thing they can do is start raising rates. So, high level, that's where we're at. Nationwide events, Helene, everything is just coming to a head where the only option they have is, if they're going to stay in the business, is to raise rates.
So John mentioned the things that were going on in California recently, the Palisades fire, things of that nature. Out here on the right coast, we've seen some similar things, not as grandiose as the California fires, but we've had a few fires this year. In Jersey, we have some flooding. We do have a little bit of lowlands, and of course, we have the Jersey Shore area. Has there really been a weather change pattern that has affected, or is this like a cyclical thing that we see going through the markets, or the P&C markets, where every few years you have some disasters, then you're off for a few years, then you have a few years where you have it, that kind of thing?
I can't say that the frequency has increased, although I think it has slightly, but the amount of the claims have gone up exponentially. Because before, look at the Palisades fire, right? Total destruction, auto and home across the board, and all these cars are more expensive. All these homes are more expensive. I mean, look at how much our home values have gone up since COVID. Well, the lumber costs so much more. It's just that much more expensive to build your home, but then also to find the contractor to come in. Back in our area, if you're trying to get your kitchen remodeled, unless it's $100,000 project, good luck finding a guy that wants to do it, right? Just because they can, charge the premium. So, but one other thing, you mentioned California. Well, John, I mean, you're in California. Why don't you tell us about California?
Well, I mean, I'm not going to get on the soapbox. You hear it all the time, Matt. I mean, California, you have companies canceling policies. You have a lot of issues in California. And, one thing our state governor and government loves to do is point the blame. Oh, it's the insurance companies. It's the insurance companies. And I get it. Insurance companies, this might come as a shocker to folks, but they're for-profit companies. And, whether it's life insurance, annuities, property and casualty, they're risk mitigators, and everything's a math problem to them. And what a lot of people don't understand was a lot of the issues that we have in California are shockingly related to our government's decisions about not managing brush, the water supplies, everything that has exacerbated our fire issues really over the last 2 decades. So let's talk about the issues in California for our listeners, and what you're seeing.
Yeah, high level, you mentioned California. I'll just start with how it's run. So a lot of people think, well, if the insurance companies needs money, they just raise my rates and they get whatever they want. That's not the case. The insurance commissioner has to approve the rate increase. And so the insurance company has to give a good song and dance as to why they should be allowed this rate increase. But California for years and has had a moratorium on rate increases, meaning, and this goes back, I believe, before COVID. Don't hold me to that, but I believe it does, where they couldn't raise rates. And that just means that every claim costs them that much more out of their pocket. So insurance companies operate on what's called loss ratios. Loss ratio just means, how much for every dollar that comes in from premium, how much are we paying out in claims? And a lot of companies, 50% loss ratio is good. That means they still have some money and they got to build up the reserves. But a lot of companies in California and even all over at times will have over 100% loss ratio. It'll have like 105, 120. Well, that means they're going into their reserves coming out of their pocket. And any other, small business can't do that too long without going, out of business, right? So you have to remember insurance companies also have insurance. It's called reinsurance. And every company is a little bit different. Like, let's say I'll pick the company I have. I won't say the name, but I believe they cover the first $1 million of claims out of their pocket. And then after that, anything over $1 million per claim, they make a claim in their insurance, in the reinsurance. And these reinsurance companies are massive. They're global. There's more than a dozen of them, but I think most of the insurance companies work with like 3 major companies. Well, these major companies, you know what? they want to make money too, believe it or not, these greedy turkeys. So, when you're making claims with them, just like your auto and home, if I'm turning in 20 claims, they're going to non-renew me. Well, that happens with the insurance company too. They turn in all these claims because it's billions of dollars. That reinsurance company says, you're a risk. You are losing us money, and we're in business to make money. So we're not going to insure you. Now, when that happens, it could be like a death spiral for an insurance company. So, for example, one big insurance company we worked with a few years ago, we were probably, honestly, it was a niche for commercial insurance. We're probably one of the top producers in the state, and I know that, for this carrier. And this carrier, I would brag on them all the time. Man, they're great at paying claims, man. I mean, they're not going to deny you. Well, lo and behold, they would pay claims even extra, like, like beyond, like, why did you even pay that? And a few years ago, we got that letter saying, hey, they got downgraded to B from AM Best. And when an insurance company gets downgraded to B, that's dangerous because what that means is, if you have a mortgage or if you have a loan, your lender says, we want you to have an A-rated carrier. And the moment your carrier gets downgraded to B, that means for you to be compliant, you've got to drop that insurance company and go find a different one. So I know State Farm actually got downgraded to a B a couple years ago. And it was just, they received a pass, if you will, because they're so massive. But otherwise, so many people that have a mortgage would have had to have moved from State Farm. But back to your question, I know I ramble a little bit. What's going on? Well, obviously, we talked about inflation. The other thing that happened right around that same time is lawsuits. So there are big hedge fund companies out there that make a living by doing data analytics on where should we sue the insurance company? You get rear-ended and you hurt your back and all those type of things. And they advertise in the big cities where they know they're going to get higher payouts. And that has really been catastrophic to the insurance company. So, for example, I'm looking at something right here on my screen where UPS driver back in 2020 sued for discrimination, and he got about $240 million. So $240 million, I mean, for a UPS driver. So another thing that happened is there is a change in how much people can sue for, as opposed to having lower caps. So across the board, it's been catastrophic for the insurance companies. California specifically, because as you mentioned, John, I think we could agree it's probably not the best run state. You could disagree with me there, but
no disagreement.
okay.
Yeah,
So
well,
if you're in go ahead.
well, I was just going to say we have a governor that looks like a woodchuck and thinks like a woodchuck, but he has hair plugs, and we're not too far behind California in the stupidity of how our government is run. And we've seen a lot of the same. We're starting to see a lot of the same problems that California has because this nitwit wants to be California, East Coast California, and
Wow.
we're seeing car rates double, we're seeing homeowners rates double, we're seeing people not being able to get flood insurance. Not that, I mean, I still question the validity of some of that. But with that said, I mean, I will lay the blame of a lot of this on the government. And I'll give you a quick example. Doesn't have to do with anything with PNC, but our illustrious governor named someone to head the regulatory board for JCP&L, who has absolutely zero experience in that type of industry. As a matter of fact, all she was before that was a secretary. And so now all of a sudden, this governor wants to start blaming the JCP&L for doubling and tripling rates because for years and years and years it was mismanaged by our government. And so we're California A1, if you want to
Yeah.
call it that, or AB, whatever. It's a disaster, man. And these people are freaking idiots. And I'm sorry, this is going to hurt some people's feelings that listen to this show. But
hmm
man, if you want to be real about stuff, these people are nitwits.
Yeah, I can't say it's any better in Washington. In fact, it's they want to be California. It seems like sometimes. So yeah, it's a challenge nationwide. But another unique thing about California, John, is that we just had a nationwide rep here in our office a couple weeks ago, and it's a big nationwide company. I'd say the name, you know it. And he goes, we're not in California anymore. I mean, we're not writing new business. And he goes, you know, another thing that just happened in California, he goes, you know, the FAIR plan. So, and it's kind of funny, you know, John, I know you follow Ed Slott, and Tom, so do I. And I remember years ago at a big Brookstone event, Ed Slott stood up there and he said, you can pretty much guarantee anytime the government comes out with a name for something, it does the opposite of what it says. And then he goes like Healthcare Reform Act, you know, and all these other things. Well, in California, and many states have what they call the FAIR plan, and that sounds great. It's fair. And what that means is if you can't get insurance in your state, you can get it through the government, basically, right? But you know what? It's extremely expensive. It's garbage coverage, and they call it the FAIR plan, right? But this was crazy. This is why this rep was so bothered by California. He said the governor or the OIC in California is requiring that all carriers in California pay those claims, even if you're not their client. So in other words, here's this FAIR plan bucket of money that doesn't have a lot of money in it because they don't do their budgeting well. You know what we're going to do? We're going to make State Farm, Farmers, Allstate, you name the company, pay for your claim when you don't even have them for their insurance. So it's just like, why would you want to do business in that state?
It sounds like Groundhog's Day to me, because back in the 80s, that's exactly how the New Jersey auto insurance industry was run. Exactly how you're describing it is exactly how it was. And for over a decade, New Jersey had the highest car insurance rates in the country.
Yeah.
And what you're describing is 2.0.
And how are your rates now? Have they ever gone down or stabilized since then?
They did for a while, and they did stabilize. I'll give Jim McGreevey credit for the one thing that he did do well, which was he revamped the whole car insurance industry. It brought in the insurance companies. There, like you said, in California, there were a lot of companies who didn't even want to come into this state. He fixed it, and for a long while it stabilized, but now it's out of control all over again. So I mean, I added my daughter to the policy, and I know high school and college age kids make it more expensive, but my rates almost tripled in the last like 3 years. It's just insane.
Yeah, I mean, well, even just with Bree and I, our rates have doubled. You know, that kind of brings me to the next point, because you brought up a good thing. A lot of the focus in California has been the poor, especially coming off the fires. Mm-hmm. It was the poor brush management, and we're seeing it all the time here, how these fires they just spark up so much easier than they used to, 20, 30 years ago. And, the biggest problem that my clients and a lot of my friends have had, we have not yet had it with our insurance company, but is people getting dropped from policies. And matter of fact, about 3 weeks ago, I just emailed you saying, hey, I've got a buddy who just got dropped. And, that's becoming, a major issue. People are paying these policies. I've had my same insurance company for 20 years, and it doesn't matter. Like, kind of like you said, they're getting out of the state, and that makes a good point as to, okay, well, everyone else is gonna fairly pay what we can't pick up. So
seen the same thing in Florida, right? I mean, that's the one thing a lot of my clients who are snowbirds, the homes, whether it's a condo, a townhouse, or just a standalone home, they're all saying the same thing. The homeowner insurance companies are running away from Florida. And when you do get it, it's like another mortgage payment every month.
Yeah. Yeah, Florida is a rough state. We actually have an agent in Florida, and it just seems like it's as bad as California. It's a rough one.
It's insane.
Yeah.
But you're right, John. I'm going to go back to your one point. The American Red Cross isn't insuring anybody, right? You don't want an insurance company that's going broke. You don't want an insurance company that's bankrupt, because then you know that no matter how much you pay in premium, you're never going to get coverage, or you're not, your claim is never going to get paid out. So it's not about capitalism. There's a lot of fingers to be pointed, but I would direct, if I had 5 fingers, but my first 4 would be directed at our local governments.
I would agree with you there. Yeah. I mean, most people in government do not understand business. They're used to taxpayer money where it seems unlimited, and if we need more money, we raise taxes. But there's very little accountability, which is unfortunate. Now, if you and I ran our business like that, we wouldn't be in business, or we'd be in jail. But what can we do? I mean, what can the insurance companies do? The insurance companies, when they start losing money, they only have three options. They can raise your rates, but but every state, the governor, or not the governor, but the OIC, Office of the Insurance Commissioner, has to prove it, right? And then what they can also do is delay and deny claims. And we do see that happening more often, unfortunately. So, for example, I was speaking to a high level guy at one of a nationwide insurance companies for auto and home. And he said, Matt, every claim that comes in the door right now, we treat it like fraud. So, in other words, they're going through every little nook and cranny and just researching for any form of fraud. So your grandma got a fender bender. They're treating it like fraud, right? And if they need to pay, they pay. But it's just high level scrutiny on everything. In fact, there's another local insurance company here. Years ago, when it first started coming out, this all started around 2019, rates started going up for all these various reasons we've already talked about. But for about a year, I get an email because we have hundreds of carriers, like over 200 direct appointments with carriers, right? And for about a year, it just seemed like every week I got a different email from a company. And it always started the same. It said, as you know, it's been a rough market. We haven't raised our rates at all. We've been great people. Unfortunately, we're going to have to send out a big rate increase this year. And then they would have new underwriting guidelines where there was one carrier that said, if someone even turned in a claim and we didn't pay a penny on it, we're not going to offer them coverage because you're a higher risk because you thought to turn in a claim. So it's a rough market. It's a rough market. And the only other thing a company can do is just pull out of markets completely, pull out of states and pull out of different types of risks.
That's what we're seeing all over the place. So I think we've beat things up a little bit here. Good enough,
I would say.
So maybe let's talk about some solutions for the listeners, Matt. What are some 1, 2, 3 simple steps that they can take to maybe help their affordability, help their claim coverage, just help them along through this process?
Yeah, I understand it's a challenging market. And the first thing I would do is regarding your deductible, right? Back in the day, people had $500 deductibles, and then we go to $1,000, $1,500. If someone called me up today and said, Matt, I have $1,000 claim to turn in, and the deductible is $1,000, well, why would you turn that in, right? You wouldn't. Well, what if it was $1,500? What if the claim was $1,500 and you had $1,000 deductible? Are you going to turn in a claim for $500? The answer to that is no, you're not going to do that. Everyone has a different budget. Everyone has a different reserve. But my point is, I'd only recommend turning in that claim when it's a financial have to. And for most people, depending on where you're at, yeah, if it's a $10,000 claim, sure, we're going to turn that in. But if it's under a few thousand and your deductible's $1,500, we're not going to recommend turning that one in. So self-insure for the first, whatever your budget is, a couple grand. Raise your deductible for comp and collision, to, 1,000, 1,500. But another thing I would do is just make sure that I would have AAA instead of paying for your towing, right? Back in the day, a towing claim wouldn't affect your rate. And you could have 20 towing claims in a year and it wouldn't affect your rate. That's changed with a lot of carriers now. So you lock your keys in your car and, your battery's dead. You're calling your insurance company. Oh, many of them are looking at that like a claim now. And if you have 2 claims, you're going to be non-renewed or rated up. So all those, get AAA. Don't pay for it through your insurance company. When you rent a car, I know this sounds crazy, but when you rent a car on vacation, consider paying the extra money for the rent-a-car insurance. It costs more now than it did in the past, depending on the car and how long you're there. But do you want to make a claim on some rental car on your insurance that's going to affect your rates and your insurability? Heck no. Pay the extra money. Use their rental insurance.
Wow, I'm glad you're saying that because as much as all of us travel, I'm always renting cars and I never take their coverage. In my head, because I've read my policy and my policy says I'm covered. I never thought, I never put that together. I'm really glad you said that because
there is no paying out a cut. If it's $1,000, damage, the claim's getting filed either way.
I'll tell you a funny story. So Amy Carlson is our P&C manager here on the for the property and casualty insurance. And this last year, she went to Hawaii. I think they're on Maui, and she rented one of those little scooters, her and her husband, and they were having fun going around, great vacation. Well, unfortunately, she had an accident, right? And she wiped out pretty good and got scraped up. She's okay, but scraped and a little bloody and whatever else. And her husband pulls up to her after her and says, "Hey, how you doing?" And all these people gather around, and she goes, first thing out of her mouth, "I'm so glad I paid for their insurance," because she knew not to make that claim on her insurance. So, point being, we want to practice what we preach here too. And one other dollar saving thing here, and that is someone in this meeting right now had a speeding ticket recently. I'm not going to say who it was, but I know them very well.
I can tell you it wasn't me.
Really? John, was that you? Was that you, John? It wasn't? Oh my goodness. Well, anyway, whoever this great guy was, he got a speeding ticket, And I understand being the guy that says, I earned it, I deserve it, I'm going to pay it. I tell you, you do not want a speeding ticket on your record right now. So I probably paid $200 for some attorney, and so I still paid, and I still paid these fees, and it cost me more than just paying for it. But now I don't have the speeding ticket on my record. So this is an environment where you don't want to turn in your window claims if you can pay it out of pocket. You don't want to turn in the little nickel and dents. It's going to get better. But today, if you want to help your rate increase not be 50%, there are certain things that you need to consider.
Wow. So part of our practice as financial planners is asset protection. And we talk a lot about the importance of protecting the wealth you've worked so hard for. But I've noticed a lot of people I talk to don't have umbrella coverage. And in a lot of our retirement courses, they talk about the importance of umbrella coverage, with the cost, the pennies on the dollar coverage. Can you talk about umbrella coverage and why it's an important asset protection feature?
Yeah, exactly. And I'll even bring up a one other thing that many of your viewers may have not heard, and that's the difference between umbrella and excess. So a lot of these insurance companies, when you call them up and say, "Hey, I want an umbrella," they say, "Sure." They'll give you a policy, and you look at it, and it doesn't say the term umbrella; it says excess. So the difference is this: excess only covers exactly what your base policy covers. As far as it's not broader coverage, right? It's going to increase your liability from 1 million to from 100,000 to the 1 million, but only for very specific things. Umbrella is broader coverage. It can extend farther. And as to what, that's up to your carrier, but you definitely would want umbrella over excess. And as far as needing it, it's as simple as this. I mean, I know you're all good drivers, but we all have, and we hope and pray everyone in our family is too. But even if they're still good drivers, accidents still happen. And if it's deemed your fault, that's millions of dollars. They're going to sue for whatever they can. And an umbrella is going to be extra protection in the event of, a car accident, something happens, it's deemed your fault. They're coming after your future earnings. They're coming after everything you have. You need an umbrella to protect you. And depending on who you talk to, I mean, there's a general rule of thumb that says, well, you want, $1 million of coverage for every $1 million of net worth, up to 20 million, and beyond that, go from there. And that's good advice. But I will say in the market, it's going to be a little harder to find, a $20 million umbrella in the market. It's usually easy to find up to 5 million. And then after that, you got to jump through some hoops. But people sue. It's a litigious society. And, that's another reason why California is so hard to do business in, John. They are the highest number of lawsuits per state is California. So you need an umbrella.
Well, one other thing I like to ask about is just last week, right? We had probably the strongest earthquake in San Diego that we've had in well over probably about a decade or so, 5.2. What's your thought on earthquake insurance? Is it legit, or is it just kind of one of those scams where even if you have an earthquake cover, even if you have the earthquake insurance, well, we don't mean we're actually going to cover the earthquake damage?
I don't think it's a scam. I think it's totally legit. But just like anything, you want to look at your carrier rating. So one thing we haven't really talked about is the quality of your carrier, their ability to pay. You do want to make sure you have an A-rated carrier, and but that's just a paper game too, because there could be stuff going on internally. But if you don't have earthquake coverage, then you're really banking on FEMA to take care of you, right? And we look. I'm sure you've heard how the people in Helene were quote unquote well taken care of are not. You don't want to bank on FEMA whenever you can. So, and obviously, if you live in an area of the country where you've never had an earthquake, then sure, But earthquake coverage, depending on where you live, is going to vary a lot in price. But it's going to vary a lot in price, especially right after a little minor quake. So for example, up here in Washington, we've had some minor quakes. After those minor quakes, I get emails from the carriers saying, "Oh, we're not offering coverage right now for earthquake," right? Or if they do, it's going to be a jacked up rate. So you got to time it depending on where you live. You need to have it before you need it, of course, but you want to make sure you get it in a season of calm, ideally, because that's when you're going to get the best rate. But that's not going to prevent you from future rate increases.
We've had 3 or 4 in the last couple of years, not as not as bad as out in California, obviously. But I don't honestly I don't even remember if is that coverage out here in New Jersey.
Yeah, I'd have to look in New Jersey. I know, like, we have it in Oregon. We have it here. We haven't had anything major either. We're probably similar to you. But for that reason, the cost of the earthquake insurance is much lower. We have lots of clients we quote out where it's $1,000 a year, for to replace your home and your contents. Now, that's going to vary on the value of your home and how much contents you have and your zip code, but it's something we can't predict. And insurance is security, it's peace of mind. If you want that peace of mind, then I would strongly recommend it. On the hierarchy of probability, one of the highest probabilities is theft and fire. So we want to make sure we have good insurance for that. Another high probability is being sued. And, that's what the umbrella is going to do, take care of us for. And then after that, that's when we get into natural events, flood, earthquake, things like that. So it's peace of mind, and that's going to be based on you and your situation.
So again, if you don't have flood or earthquake and you have a major, your house is flooded or you have major foundational damage from an earthquake, without that coverage, you're depending on FEMA.
You're depending on FEMA, which in essence means you don't have coverage. So you have to keep that in mind.
And we've already explained how well the government takes care of us, that I'm sure FEMA will do an incredible job for you. Sarcasm built into that comment for people who don't know me. So on a little bit of a lighter note, maybe, the little things that people are told to do they really affect rates? Things like taking a defensive driving class, making sure you have 3 or 4 fire extinguishers in your house, the carbon monoxide alarms, fire alarms, outside lighting to your home that's maybe a motion detector lighting. But do those things, those little expenses that we all go through to properly help maybe defensify our home, do they really help?
They do really help, but each one of those is just a little bit. It's not going to make thousands of dollars of difference in a premium. And one thing you want to do too is make sure that, this is an area where people often fudge, if you will, when it comes to saying your college degree and all these things that you put down. And carriers do look at that. And carriers do, if they feel like you're not telling the truth and applying for too many discounts, that's not a situation you want to be in because that'd be insurance fraud. So we want to be truthful. But yeah, I mean, all those little things often give you a slight discount. But just to be clear, some of them, like the fire extinguishers and smoke detectors, some of them are more of a requirement to even get coverage.
Yeah, I think nowadays in newer homes, yeah.
Yeah. Everything adds up. Yep.
Now we talked about floods and we don't have it, parts of San Diego are low lying, but is basic home insurance going to cover other things like, your dishwasher or your washing machine floods the upstairs, or, not that we have this problem in California, in Jersey you might, but you have frozen pipes or a slab leak.
Or your
It,
water heater leaking.
yeah.
Yeah,
Is that going to be you need extra insurance for that, or is your main policy going to cover those?
good question. The rule of thumb is this. Is it outside water coming in? If it's outside water coming in, river coming up or whatever else, that's flood insurance and only flood insurance. If it's an internal, like a pipe froze and it burst, that's going to be on my regular house insurance, so I'm good to go. So frozen pipe and it burst, boom. Well, we saw it happen right here. We took care of it. We don't have to add coverage for that. I mean, when in doubt, sure, confirm with your carrier because every carrier can be different. But generally speaking, that's included on your policy. Now, one that isn't it's called leakage and seepage. So that would be like you got that slow leaking pipe. Years ago in my house, my house was built in 2002. Years ago, I was, taking a shower, believe it or not. I like to do that every now and then. And I leaned against the tile wall. Yeah, I know. I leaned against the tile wall and poof, it went right through the wall. And I'm like, ah, crap. Well, lo and behold, I had some leakage and seepage. And you know what? Was not covered. And it was probably, it was probably easy back in the day. $20,000 claim. Right now, it'd probably be more like a $40,000 claim. So leakage and seepage, you want that added to your policy. It's not that expensive. That's that slow drip that causes that mold. You find months later, years later. You definitely want to add that to your policy because
How
that's
about
generally
how
not
about
added.
sewage? How about sewage backup? That's not your fault.
Usually that is covered on the main policy, where sewage backup is usually covered on the main policy. Yeah. Good question.
Now, one other
Oh,
thing I heard.
how about my baseball cards?
Oh, that's contents coverage. That's good. So contents coverage, sometimes they'll have dollar limits for expensive things, like maybe a $2,500 limit on your guns, or maybe a $5,000 limit on your surgery. I'm sorry, your jewelry. Anything beyond those limits, you need to have it added additionally, and just to make sure that you have the right limits for that. So any collectibles, anything like that, most of your items. Well, let me clarify. That would be for like theft. So if someone came in and stole your baseball cards or stole your jewelry or stole your gun collection, that would be covered up to those limits for theft. Anything beyond that limit, which is usually pretty low, you want to make sure that you have an increased limit and you list out those items. Now, if it's fire, then that's covered under your contents. So whatever your contents limit is, that contents is anything that's not attached to the wall, right? So it's your clothes, it's your furniture. If it's fire, then I don't have to additionally list, my gun collection or whatever other, things that I have.
And
Not that any of us have a gun collection, if anybody's
Oh,
listening.
No, mine were lost in a boating accident.
um, bringing up the fire and I know Tommy's got quite the collection. I'd seen on a financial blog that said that people should actually go through their homes with their phone and record all of their belongings, all the way down to the spice cabinets, because you could be leaving a lot of money on the table if you don't have a good record of that.
And that is the best way to do it because you're going to upload it to your server. So even if your phone's, destroyed, you have it uploaded in the cloud. You definitely want to do that.
I gotta get to work, man.
One other question, because you talk about claims and how the smallest claim is going to jack up your homeowner's insurance. What is your thoughts on getting like separate jewelry policies for the wife's wedding rings or your watch collection, stuff like that?
I would price it out both ways. And when I priced it out for me, it was better just to put it on my current policy, just because if it is a fire, you're making a claim no matter what. So whether they're paying out, 100 grand for your contents or 200 grand for your contents, it's a big claim either way. So I have it under one policy. But depending on the jewelry and depending on what you're trying to insure, if your carrier doesn't like, some of the things that you have, because maybe they're a little persnickety about this or that, then I'd get it priced out as a separate policy as well.
What about in terms of just the claim versus premium? Like, hey, all right, you lost your wedding ring on
That is definitely better to have that on a separate policy, just for jewelry, just on a jewelry policy. Yep. So if you're talking about someone stole my one item or my jewelry collection, that is definitely better to have as a jewelry policy separate from your homeowner's policy. Because if you get a 10% rate increase on your jewelry policy that was $100 a year, well, okay, now it's $10. But you get a 10% on your homeowners and autos, well, that's a lot, hundreds of dollars easy. Yeah, good question. Yeah, and let me throw this out there too. So we talk about shopping it out. So on your homeowners, another thing that people don't realize is there's a thing called an insurance score. That insurance score is a mix of various things, but it includes your credit score. It includes your claim activity, but it also includes your loyalty, right? You've heard of loyalty discounts. And there is something to those loyalty discounts, but it's not as big as you think. My point is this. You're not going to switch your insurance every year. You shouldn't, because that really lowers your insurance score, because people want, insurance companies, they're creating a residual income, if you will. They want a good base. So I wouldn't shop out my insurance every year, but if it's been a few years since you've shopped out your insurance, you need to do that. You need to work with a broker that has a lot of carriers. I mean, check with all the direct carriers like Allstate, State Farm, Farmers. But in addition to that, find a good broker in your area that has hundreds of carriers and have them shop it out. But again, shop it out, but don't change carriers every year. It's not a good look.
Awesome.
Cool.
Well, Tommy, and I got some work to do too. I mean, I've always kind of looked at that earthquake coverage as it's just kind of a little add-on scam item. So definitely learned a lot, man. I appreciate you taking almost an hour out of your time to come and educate us, because there's a lot in this ever-changing world, and I think PNC has seen a lot of change in the last 5 years. So I've got a lot of work to do. What say you, Tommy?
Oh, I have a lot of videotaping to do. There's a lot of cards to spread out on the floor.
Yeah. So, and folks, if you have a need for a good broker, Matt and his company, Vault Insurance and Investments, they're throughout the nation. Give them a call. You can visit their website at choosevault.com. And, if they can help you out, they're a great team. And Matt is by far one of the most knowledgeable people I know, especially in the insurance industry. So, Matt, thank you for coming on the show. We appreciate all your knowledge and look forward to having you on in the future. Talk about more PNC problems.
We'll see you in Dallas too, right?
I'll see you there. I'll be there. Looking forward to it, guys. Thank you so much, guys.
Yeah.
Thanks, man.
Yeah. And folks, we just love having another great guest to give you the knowledge you need to protect the wealth you've had. So we hope you've enjoyed this show. Until next time, folks, retire happy. Take care.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.